It's not our job. Ladies and gentlemen, I need you to listen very carefully, because what I am about to tell you could change the way you look at money for the rest of your life. I do not say that for drama. I do not say it to scare you. I have spent 40 years watching capital move before the public understands why it moved. I have watched people with Ivy League degrees, 8-figure portfolios, and entire research departments make the same mistake again and again. They confuse price with value, they confuse currency with wealth, and they confuse a temporary red screen with a broken thesis. The biggest wealth transfer in modern history is coming. I believe that. And I believe it is coming through silver. Not because silver is fashionable. It is not. Not because the financial media is talking about it. They are not. Not because retail investors are piling into it. They are not. That is exactly the point. The greatest transfers of wealth never begin when everyone is excited. They begin when everyone is exhausted. They begin when an asset has been mocked, ignored, suppressed, and abandoned by people who no longer have the patience to understand what they own. And if you hold silver right now, I know what you are feeling. You are tired. You are frustrated. You have watched gold move and silver lag. You have watched inflation eat away at your grocery bill, your insurance bill, your rent, your energy costs, and yet silver still refuses to behave the way it is supposed to behave. You bought it because you understood the debt problem. You bought it because you understood the printing press. You bought it because you knew paper money was fragile. And still your screen has punished you. So let me ask you something. Did you buy silver because you wanted a quick trade, or did you buy it because you understood that the monetary system itself is changing? That question matters. Because if you do not know why you own something, you will sell it to someone who does, and that is how wealth transfers, quietly, legally, mechanically, from the impatient to the patient, from the frightened to the prepared, from the people who look at price to the people who understand value. By the end of this video, I want you to understand the exact mechanism behind this transfer. I want you to understand why silver can remain suppressed for years and then move violently in a matter of months. I want you to understand why this is not simply about inflation, not simply about recession, not simply about the dollar, and not simply about industrial demand. It is all of them converging at once. And later, I am going to give you one number, one very simple number. That explains why even a small amount of institutional money moving into silver could overwhelm the entire market. When you hear that number, you cannot unsee this. Let me start with the thing most people still refuse to accept. The money in your bank account is not wealth. It is a claim. It is a promise. It is an entry in a system that depends entirely on confidence. That does not mean it has no use. Of course it has use. You pay your bills with it. You receive your salary in it. You buy groceries with it. But do not confuse utility with permanence. Paper currency is useful until confidence weakens. And when confidence weakens, the adjustment is brutal. The dollar has lost more than 90% of its purchasing power since the creation of the Federal Reserve in 1913. I want you to think about that slowly. More than 90%. That means the destruction of purchasing power is not some wild theory. It is not some extreme future scenario. It has already happened. It happened over a century. It happened quietly enough that most people accepted it as normal. But it happened. Every generation was told their money was safe, and every generation watched that money buy less. People call it inflation. I call it what it is, a transfer. Inflation transfers purchasing power away from savers and wage earners and toward debtors, asset owners, and those closest to the creation of money. This is not opinion. This is mechanical. Write this down. Every currency system built on unlimited issuance eventually faces the same problem. The political temptation to create more money becomes stronger than the discipline required to preserve its value. Every single time. Now, I am not telling you that tomorrow morning the dollar goes to zero. That is childish thinking. Systems do not usually fail that way. They fail in stages. First, the currency buys less. Then the public notices. Then policymakers deny it. Then they intervene. Then the intervention creates more distortion. then the distortion requires more intervention. And eventually, the public realizes the money was never solid. It was confidence dressed up as paper. This is where silver enters the story. Gold is the senior monetary metal. Central banks understand gold. Sovereigns understand gold. The wealthy understand gold. But silver is different. Silver is the monetary metal the public can still reach. Silver is the pressure valve. Silver is the smaller market. Silver is the metal that gets ignored until the system starts shaking, and then suddenly everyone discovers it at once. And that is why the transfer is coming through silver. But before I explain the opportunity, I need you to understand the suppression. Because right now, many silver holders are making the wrong conclusion from the right pain. They see silver underperforming, and they assume the thesis is dead. It is not dead. It is being compressed. Here is the mechanism. A geopolitical shock hits. Oil rises. Inflation expectations rise. The market starts pricing out Federal Reserve rate cuts. Bond yields stay elevated. The 10-year Treasury sits in the 4 to 5% range. Suddenly, silver, which pays no interest, looks less attractive to short-term capital. At the same time, fear pushes money into the dollar. The dollar strengthens. Because silver is priced in dollars, a stronger dollar mechanically pressures silver lower. So you get three headwinds at once. Higher yields, stronger dollar, higher opportunity cost, all hitting silver from the same event that should eventually be bullish. That is why the screen confuses people. War should be bullish. Inflation should be bullish. Debt should be bullish. Central bank distrust should be bullish. But the first move is often lower because the market trades the rate mechanism before it trades the monetary reality. This is not opinion. This is mechanical. And here is where almost everyone gets fooled. They assume the first move is the truth. It is not. The first move is positioning. The second move is liquidation. The third move is reality. I have watched this pattern for decades. In the 1970s, precious metals were mocked until they were not. After Nixon closed the gold window on August 15, 1971, the old monetary world ended. Gold had been fixed at $35 an ounce. By January of 1980, gold reached $850, a 24-fold move. Silver moved even more violently, from under $3 in the early 1970s to nearly $50 in 1980. That was not a normal rally. That was a monetary re-rating. Then came another cycle. After the 2008 financial crisis, the world learned that the banking system was far more fragile than the public had been told. Central banks cut rates to zero. They printed. They expanded balance sheets. Gold climbed from roughly $700 during the crisis panic to over $900 by 2011. Silver ran from below $10 in 2008 to nearly $50 in 2011. That was not random. That was not speculation alone. That was capital trying to escape a system it no longer fully trusted. Every single time confidence in paper weakens, hard money comes back. Every single time. Gold moves first. Silver frustrates people. Then silver catches up violently. Every single time. Let me be blunt with you. Silver is not polite. Silver does not move in a smooth line to make you comfortable. Silver does nothing for years, makes you question your intelligence, then compresses an entire decade of returns into a handful of months. That is its nature. That is why most people never receive the transfer. They cannot survive the waiting period. Now I need you to understand the three forces converging beneath silver right now. These are not small forces. These are not trading narratives. These are structural forces. The first force is the debt spiral. The United States is carrying more than $39 trillion in federal debt. Annual interest expense is running around $1.3 trillion. That is not a political talking point. That is arithmetic, and arithmetic does not care what party is in office. Roughly $9 trillion of debt must be refinanced in the next 2 years, not at the 0% rates of the last cycle, but at rates closer to 4 or 5%. That means the debt burden becomes heavier even if nothing else goes wrong. So what are the choices? Cut spending dramatically, raise taxes dramatically, default openly, or inflate the debt away quietly. I have seen enough cycles to know which option governments choose. They choose inflation, not because they announce it. They choose it because every other option is politically impossible. They debase slowly. They manage the narrative. They tell the public inflation is temporary, then transitory, then sticky, then acceptable. They change the language, but the mechanism remains the same. Write this down. A government that cannot afford honest money will eventually choose cheaper money. Every single time. The second force is the loss of trust in the dollar-based reserve system. In 2022, roughly $300 billion of Russian central bank reserves were frozen by the United States and its allies. I am not here to debate the politics of that decision. I am telling you the financial consequence. Every country on earth saw the same message. Reserves held inside the system can be frozen inside the system. That changed behavior. China noticed. India noticed. Turkey noticed. Saudi Arabia noticed. Every finance ministry noticed. And what did central banks start doing? They bought gold at a record pace. China bought month after month. Poland added. Turkey added. India added. Singapore added. The institutions that issue paper currency began accumulating. The asset paper currency was supposed to replace. That is not a coincidence. That is a signal. But here is the part silver holders need to understand. Sovereign demand begins with gold, but monetary anxiety does not stop at gold. Once the public institutions, pension funds, family offices, and smaller nations begin looking for hard assets, they discover silver. And silver is a much smaller door. Gold is a large market. Silver is not. That difference matters. A small flow into gold moves gold. A small flow into silver can detonate silver. The third force is industrial demand, and this is where silver becomes unique in the entire financial system. Gold is monetary. Copper is industrial. Silver is both. Silver is the most electrically conductive metal on Earth. It is essential in solar panels, electric vehicles, semiconductors, defense systems, 5G infrastructure, medical devices, and AI data centers. Every technology that politicians, corporations, and governments say they want to build requires silver. Solar alone consumed over 200 million ounces of silver last year. Some projections show solar demand moving toward 400 million ounces annually by 2030. Current global mine supply is roughly 830 million ounces a year. Think about that. One industry could demand nearly half of annual mine supply within a few years, and supply is not flexible. This is critical. Roughly 70% of silver is mined as a byproduct of copper, lead, and zinc. That means if silver doubles, miners cannot simply double silver production. They would have to mine more copper, more lead, more zinc. The silver market does not have a normal supply response. New mines take 7 to 10 years to permit, finance, and build. The metal cannot be printed. The metal cannot be created with a policy meeting. The metal is either there or it is not. This is not opinion. This is mechanical. Now combine those three forces. Debt debasement pushes people toward hard money. Dollar weaponization pushes nations toward physical metal. Industrial demand consumes silver permanently. And supply cannot respond quickly. That is the setup. That is the transfer. So why has the price not already exploded? Because markets do not reprice reality the moment reality appears. Markets reprice reality when the last seller is exhausted. That is the part people miss. The fundamentals can be obvious for years before the price responds. During that time, impatient holders sell. Discouraged holders give up. Leveraged holders get forced out, and strong hands accumulate. There is a phase in every major rating where the asset looks broken right before it becomes obvious. I call it the absorption phase. You see weak rallies. You see failed breakouts. You see headlines mocking the asset. You see retail lose faith. That is when large capital accumulates without announcing itself. They do not ring a bell. They do not tell you they are buying. They let your frustration provide their liquidity. Does that sound familiar? If you hold silver, it should, because that is exactly what this market has felt like. Now, I want to tell you a story because data alone does not teach this lesson. On August 15, 1971, a Sunday night, the President of the United States went on television and announced that the United States would suspend the convertibility of dollars into gold. Most Americans did not understand what they had just heard. They thought it was policy language. They thought it was temporary. They thought life would continue as usual, but the old world ended that night. The next morning, the dollar was no longer the same instrument. The gold price of $35 was no longer a real market price. It was a memory. And over the next 9 years, people who understood that night watched gold climb from $35 to $850. The people who waited for confirmation waited until the price had already moved. There was no perfect entry. There was no comfortable moment. There was only before the re-rating and after the re-rating. That is what people do not understand. A monetary re-rating does not ask for permission. It happens when confidence crosses a line. And once that line is crossed, the old price never returns. There is a day like that coming for silver. I cannot tell you the date. Anyone who claims they can is selling you certainty they do not possess. But I can tell you the conditions that precede it. Persistent deficits, rising industrial demand, weak public interest, growing distrust in currency, heavy debt loads, central banks buying hard assets, paper markets suppressing price while physical demand tightens underneath. That is where we are. Now let me give you the number I promised you. Global pension funds control more than $50 trillion. If only 2% of that capital decides it needs exposure to precious metals, that is $1 trillion, $1 trillion. Now compare that to silver. The above-ground investable silver market is estimated around 2 to 2.5 billion ounces. At $30 an ounce, that is roughly $60 to $75 billion. Even at higher prices, it is tiny relative to global institutional capital. Do you understand the math? A $1 trillion allocation cannot fit through a $60 or $75 billion door. It cannot. The price must change, not gradually, dramatically. That is the wealth transfer. It does not require a collapse tomorrow. It does not require the end of civilization. It does not require every bank to fail. It simply requires a small percentage of large capital to decide that paper promises are no longer enough and that hard assets deserve a permanent place in portfolios. When that happens, silver does not need everyone. It only needs a tiny fraction. And this is why silver is so dangerous to ignore. It sits at the intersection of monetary fear and industrial necessity. If the economy weakens, monetary demand rises. If the economy strengthens through electrification, AI, solar, and defense spending, industrial demand rises. Silver has two engines. Most assets have one. But let me warn you about something. Silver will try to shake you out before it rewards you. It always does. It will fall when you think it should rise. It will lag gold until you cannot stand it. It will make headlines look foolish and analysts look early. That is how the transfer works. If silver moved smoothly, everyone would hold it. If everyone held it, there would be no transfer. Write this down. The discomfort is not a flaw in the setup. The discomfort is the price of admission. So what should you watch? Not the television panel, not the daily headline, not the latest politician telling you inflation is under control. Watch the dollar. Watch yields. Watch the physical market. When the dollar index breaks below 97 and stays there, one of the major headwinds against silver begins to fail. When the 10-year Treasury yield breaks below 3.5% and stays there, the opportunity cost argument against silver weakens sharply. And when physical inventories keep tightening while price refuses to reflect it, understand what you are seeing. You are seeing pressure build beneath the surface. The war headlines will not tell you. The inflation headlines will not tell you. The financial media will not tell you. They will explain it after the move. They always do. This is not opinion. This is mechanical. Now, I want to speak to the person watching who is still skeptical. Good. You should be skeptical. Blind belief is dangerous. But ask yourself a simple question. What part of the current system is built on restraint? Government spending? No. Central bank balance sheets? No. Deficits? No. Consumer debt? No. Corporate leverage? No. Political promises? No. Everywhere you look, the system depends on more issuance, more borrowing, more refinancing, more confidence. And then look at silver. Fixed supply, rising demand, monetary history, industrial necessity, no counterparty risk if held physically. No central bank can print it. No government can create it with a speech. Which one is fragile? Which one is real? People say silver is volatile. They are right. Silver is volatile. But volatility is not the same as risk. Risk is holding all your wealth in promises issued by institutions that must continually devalue those promises to survive. Risk is believing a 401k balances wealth without asking what the dollars inside it will buy in 10 years. Risk is assuming that because the system worked yesterday, it must work tomorrow. Let me be very clear. I am not telling you to panic. Panic is how wealth leaves your hands. I am telling you to think. I'm telling you to understand the structure before the crowd understands it. I am telling you that the largest gains in financial history have gone to people who positioned themselves before the headline became obvious. There are two types of investors watching this right now. The first type sees silver struggling and concludes it is dead. They look at the chart. They feel the frustration. They listen to people who never understood the thesis in the first place. They sell because they want relief from discomfort. And later, when silver finally moves, they will say the same words I have heard for decades. I knew I should have held. The second type sees something different. They see a monetary system built on expanding debt. They see a dollar that has already lost more than 90% of its purchasing power. They see governments trapped between inflation and default. They see central banks buying hard assets. They see industrial demand rising from solar, electric vehicles, AI, defense, and semiconductors. They see mine supply that cannot respond. They see a market too small for serious institutional capital. And instead of panicking during the suppression phase, they accumulate quietly. I have watched both groups for 40 years. The first group always sounds reasonable at the bottom. The second group always looks early until suddenly they look brilliant every single time. So I want you to remember where we started. I told you the greatest wealth transfers do not look like opportunity at first. They look like pain. They look like boredom. They look like being wrong. They look like holding an asset nobody wants to talk about while the rest of the world chases whatever is moving this quarter. That is where silver is today. The transfer is not coming because silver is shiny. It is coming because silver is scarce, useful, monetary, under-owned, and sitting beneath a financial system that has become dependent on promises it cannot fully keep. Paper is a promise. Silver is a thing. Promises can be broken. Things cannot be printed. You can ignore that if you want. Many people will. You can wait until the headlines confirm it. Many people will. You can wait for silver to break out, wait for the financial media to call it a new bull market, wait for your neighbor to start talking about it, and then try to buy the same metal everyone else suddenly wants. But understand what that means. By then, you are not early, you are liquidity. I am telling you this calmly because panic is useless. But I am telling you seriously because the window does not stay open forever. When silver moves from accumulation to re-rating, the conversation changes. The old price becomes a memory. The people who prepared are called lucky. The people who ignored it call the move unfair. And the wealth transfer completes exactly the way it always does. You do not have to believe me today. Just watch the debt. Watch the dollar. Watch yields. Watch physical supply. Watch who is buying hard assets while telling the public the system is stable. And when the pieces begin to move together, remember this moment, because once you see it, you cannot unsee this. If this is the kind of clarity you come to WealthWIRED for, the kind that reaches you before the headlines do, the kind that explains the mechanism while everyone else is still reacting to price, then make sure you are here when silver moves from quiet accumulation into breakout. Because when that happens, the biggest wealth transfer in history will no longer be coming. It will already be underway.